Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 2, and this is Section B, and this is an application topic. Prepare any required journal entries to record the transfer of trade receivables, and that would be secured borrowings, factoring, assignment, and pledging. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions. What are you going to be doing on test day? You're going to be answering multiple choice questions and sims. You're not going to be tested on how you can watch a video lecture. You're not going to be tested on how well you can read a book. You're going to be tested on how well you can answer multiple choice questions. So that is the main idea behind SuperfastCPA, among other things, of course. But it is to dive straight into the questions because that is the best way to learn how to pass the CPA exam. And if you want to learn more about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. We go over the key ingredients to passing the CPA exam, and we will show you how to pass the CPA exam without wasting months or even years of your time by being efficient and effective with your studying. Make sure you go check that out. And also, just letting you know, we will only be going over 5 questions in today's video, whereas SuperfastCPA Pro members will have access to the full 10-question video when we post it in the members forum. So if you like this, if you like our other videos, if you like our other strategies, just remember that if you become a SuperfastCPA Pro member, you will get access to the full 10-question videos that we have made for the Pro members, and of course, you'll get access to other materials as well. And with all that said, let's dive straight into the questions. All right, here we are at question 1, and one strategy we always like to point out about going through the questions as your main learning material is it's always a good idea to read the last part of the question to give yourself context for what you're looking for in the rest of the question. It doesn't always work, but it is a great habit to be in. So let's start here. What is the appropriate journal entry to record this transaction? So we know already that we're trying to figure out a journal entry. So let's go up here. A company obtained a short-term loan for $50,000 from a bank and pledged $80,000 of its trade receivables as collateral. The company retains control over the collection of the receivables and will use the cash collected to repay the loan. Okay, so with all that information, again, we have to figure out what the journal entry is. If you have any idea how this works, that's great. Pause the video and maybe think through this and see if you can think of the journal entry. If you've never seen this before, that's okay. We're going to dive straight into the answer because, again, we're using the questions to learn how to do this. So let's go ahead and look at the answer. All right, here we are. The answer is A, you would debit cash for $50,000 and you would credit notes payable for $50,000. So it's quite simple. It's pretty straightforward, pretty much just a normal loan. So let's walk through this and kind of understand what pledging is. And we'll also talk a little bit about secured borrowing and assignment because, as it turns out, those are pretty similar, especially as far as it goes for the CPA exam. So let's talk about pledging first. Pledging receivables means using the receivables as collateral without transferring ownership or creating a separate receivables account. The appropriate journal entry is to debit cash for the amount received and credit notes payable for the same amount. The receivables continue to be reported as usual on the balance sheet. There is no impact on the accounts receivable account since the receivables are not sold or assigned. And we'll talk about assigned here in just a second. It's very similar to pledged. But again, the idea with pledging is you're not getting rid of your receivables. You're not really doing anything with them. All you're saying or doing is you're getting a loan, and as part of the loan, you're saying that if you default on the loan, you will give these receivables to whoever is giving you the loan, because that's what collateral is. So that is the main idea behind pledging. Now, let's talk about secured borrowing, assignment, and pledging all together as far as the CPA exam goes. So secured borrowing at a basic level is the general idea / category of using accounts receivable as collateral. So assignment and pledging seem to fall into this category. So when it says that in the blueprint, secured borrowing, it really is just talking about what assignment and what pledging are, which is using your accounts receivable as collateral to get a loan. So secured borrowing, as far as that definition goes, is kind of just a broad categorization. Now let's talk about the difference between assignment and pledging. It's really not that big. If the borrower defaults, the lender in an assignment agreement can immediately start collecting from the specified receivables because the lender already had the legal right to those specific receivables. So assignment, very similar to pledging, but it's a little bit more official. The specific receivables that you have as collateral, you have actually signed something saying very specifically, if we default on this loan, these specific receivables will go to the lender. And so they're assigned to the lender. The lender will have the immediate right to those if the loan is defaulted. Now, that's a little bit different than pledging. At pledging, it's a little bit less specific, little bit less like official, as in like with a document and stuff like that. So if if something happens where it's defaulted and those receivables need to be brought forward, it might be a little bit more complicated because it hasn't already been specifically assigned to the lender. But overall for the CPA exam, the difference here doesn't really matter that much because in the end the idea is the same. The loan is given and accounts receivable are assigned or pledged, however, as collateral, and the lender can only start collecting the accounts receivable upon the default of the loan. So that's why it's quite similar, and it doesn't seem to really matter that much because the only thing that you really need to remember is that with assignment and with pledging, those accounts receivable, nothing really changes with them. They're just collateral until the loan is defaulted on. That's when the receivables can be taken, and that's where the difference for assignment and pledge is, how quickly those can be taken and who has the legal right and things like that. But again, as far as the idea of somebody pledging their receivables as collateral, assignment and pledging are very similar up until the point of default, which doesn't seem to be a big focus for the CPA exam. So that's pretty much all we're going to talk about with pledging and assignment and secured borrowing. The rest of this, we're going to be talking about factoring. So let's go to the next question. All right, here we are at question 2. Which of the following options best describes factoring without recourse? Okay, so if you have any idea what factoring is, that's good. If you don't, again, that's fine. And then also, it seems like there's factoring without recourse. Maybe there would be factoring with recourse. Who knows? Let's go ahead and read through these options just to kind of give you an idea of how to kind of read through this. The factor purchases the receivables and assumes the risk of uncollectible accounts, releasing the selling company from any future liability. Okay, the factor purchases the receivables but retains the right to return any uncollectible accounts for the selling company, who must then reimburse the factor for those accounts. Okay, the selling company uses the receivables as collateral for a loan. Okay, so collateral, we were just talking about pledging and assignment and things like that with the factor holding a security interest. So that one seems a little bit less likely just because we were talking about something already that had collateral. So maybe factoring has collateral, but that seems like it might not be along the same lines. The factor acts as a collection agent and returns any excess amounts to the selling company. Okay, so again, not super clear yet. If you have any idea what this is, that's great. You probably already know the answer. If not, that's okay. We're going to look at the answer to learn what factoring without recourse is. All right, here we are. The answer is A. The factor purchases the receivables and assumes the risk of uncollectible accounts, releasing the selling company from any future liability. So that would be factoring without recourse. So let's walk through this. So the reason option A is correct, it describes factoring without recourse. So that's obviously why it's correct, but let's learn what that means. In this type of arrangement, the factor or buyer of the receivables, so the factor is the person buying the receivables from the seller, they purchase the receivables and assume the risk of uncollectible accounts. The selling company has no further obligation and is released from any responsibility if the customers do not pay. And if you've ever heard with or without recourse, maybe in taxes or things like that, without recourse means that you have no recourse. You can't go back to that person if something goes wrong and say you're responsible for this because you are taking on the responsibility. That's what without recourse means. With recourse means you can potentially go back to that person and say, hey, why didn't I get the money for this? It's your fault that I didn't get the money, or things like that. So without recourse, basically you're straight up selling the receivables to a factor. The factor is taking on full responsibility for those receivables. If some of them are defaulted or some of them are not collected, that's the responsibility of the factor. It's no longer the responsibility of the seller. So that's factoring without recourse. And we're going to talk a lot about factoring, so let's just keep going. Option B describes factoring with recourse. In this arrangement, the factor can return uncollectible receivables to the selling company, who must then reimburse the factor. This means that the selling company still bears the ultimate risk of non-payment. They may not always give the receivables back to the company, but they may still require some kind of a reimbursement for the receivables that were uncollectible. So with recourse means they can go back to the selling company and say, hey, these weren't collectible. You need to make sure that we get the money in some way or some form. Option C describes a secured borrowing arrangement, not factoring. The receivables are used as collateral for a loan rather than being sold. And remember, secured borrowing is kind of just a general term for the idea of something that's kind of like pledging or assigning, things like that. Option D is incorrect because it describes a collection agency agreement, which is not something we're talking about in this video, where the selling company still owns the receivable and the factor is merely collecting on its behalf. Again, that's not something we're talking about in this video. So the idea here was to teach you what factoring without recourse and with recourse is. Let's go to the next question. All right, here we are at question 3. How much cash will Harvest Corp receive from the transaction? And it looks like I didn't bold that. That's all right. So we're trying to figure out how much cash they're going to receive. So let's see what's happening to see why they would be getting cash. Harvest Corp sold $750,000 of its trade receivables to a finance company in a factoring agreement without recourse. Okay, so we just learned about that. Remember, without recourse means that the factoring company, the people who are buying it, are taking on responsibility for the receivables from that point on. As part of the agreement, the finance company will keep 8% of the receivables as a reserve for potential adjustments and charge a 5% fee on the total receivables sold. So they are kind of getting money from this in a way. How much cash will Harvest Corp, and remember, Harvest Corp is the one selling the receivables, they're not the factor. So how much money will Harvest Corp receive from the transaction? So if you want, go ahead, pause the video, kind of think through this. It's not too complicated. There's basically 2 ways that you could do this. One way that is the right way and one way is the wrong way. So pause this, try to do it yourself and see if you get it done correctly or see if you get the incorrect way. And I'm going to explain both ways in the explanation. So again, pause the video if you want. If not, that's okay. We're going to go to the answer now. All right, here we are. The answer is C. $652,500 is how much money Harvest Corp, again, they're the one selling the receivables, that's how much they will receive. So let's walk through this. So they sold $750,000 worth of receivables. The reserve that was kept by the factor, so the factor is wanting to keep some of the receivables for themselves. They're not, paying for these receivables. They just want the receivables themselves without having to pay. 8%. That's going to be 8% of $750,000. That's $60,000. The fee, this is a little bit different than this reserve. The fee is them just saying, hey, this is how much money we're going to charge you for us to buy your receivables from you. And that's usually kind of how they make money. These kinds of fees, commissions, or whatever you want to call it. That's 5% of still the $750,000. And I'll talk about that in a second. So $750,000 less the reserve, less the fee. And that's right here. That's done right down here. That gives you the cash received of $652,500. So that's the key right here. Let's talk about the error. And again, we're going to talk about the key right here. Make sure you calculate each separately based off the total receivables sold. So you want to calculate the reserve, you want to calculate the fee based off the total receivables sold, and you want to do them separately. They don't have anything to do with each other until you're subtracting them from the total cash. So why does that matter? Because if you may have done this, if you were watching and doing it yourself, you may have done this in order where you first take the reserve out, so you subtract the reserve, so it's now $690,000, and then you calculated the fee based off of the amount that was left after taking out the reserve, so that would have been $34,500 instead of $37,500 for the fee, and that would have gotten you $655,500 instead of the correct answer, which is $652,500. So it does matter that you are doing it separately rather than kind of, in order based off of each other. So I hope that makes sense there. Again, you are calculating the reserve and the fee separately based off the total receivables sold, and then you're subtracting it from the cash to see how much money they actually got, instead of doing the reserve, subtracting it, and then multiplying the new amount by the fee. And, again, that's the wrong order. That will get you the wrong answer. So I just wanted to make sure that we pointed that out. So that was factoring without recourse from the seller's perspective. Let's go to the next question to talk about the buyer or the factor's perspective. All right, here we are at question 4. What is the appropriate journal entry for Factor Co. to record this transaction? Okay, so we're doing a journal entry again this time. Factor Co. purchased $500,000 of receivables from Sunset Corp. in a factoring agreement without recourse for $450,000. Okay, so we know that Factor Co. is the factor in this case. They are purchasing the receivables without recourse. Okay. Factor Co. expects 2% of the receivables to be uncollectible. So the factor is expecting 2% of them to be uncollectible. So with all that information, what is the appropriate journal entry? Now, we haven't really talked too much about the journal entries, or really at all about the journal entries specifically when it comes to factoring. So if you want, go ahead and try this out, kind of think through it, think through the journal entries yourself. If you have no idea how to do this, that's okay. We're going to go to the answer. But again, if you want to try, look through these different options and kind of figure it out yourself and see if you can get the right answer. Besides that, again, we're going to go to the answer. All right, here we are at the answer. The answer is B. You would debit the accounts receivable for $500,000. You would debit credit loss expense for $10,000. You would credit cash $450,000. You would credit allowance for credit loss $10,000. And you would credit gain on factoring $50,000. Now, That's a lot of information there, so let's walk through all of this. And by the way, I just want to point this out. Debiting accounts receivable, you could also debit trade receivables. It's pretty much the same idea. Trade receivables maybe even would be slightly more correct. But again, the idea is just receivables in general. You're debiting the receivables because you're receiving them as the factor. So now let's walk through this. When a factor purchases receivables without recourse, they record the receivables at their full value. So the factor is taking on the full $500,000 there. And they account for the expected credit losses using a credit loss expense and an allowance for credit losses. And we'll talk about that in a second. The difference between the amount paid, so they paid $450,000, and the full value, again, the $500,000, is a gain on factoring because they paid $450,000, but they got $500,000 of receivables. So that's a $50,000 gain right there. That's why there's a gain on factoring, since the buyer, again, paid less than the full value of the receivables. Now let's talk about the credit loss expense. That would be that 2% that they're expecting will not be able to be collected. So that's the $500,000 of the total receivables multiplied by the 2%, and that's $10,000. So that's how much of the receivables they're expecting to be uncollectible. And the other side of that credit loss expense is the allowance for credit loss. That is the same. It's like that's the credit to the debit. Essentially, the credit loss expense is what raises the allowance for credit losses to where the company wants it to be. So kind of similar to bad debt expense and allowance for doubtful accounts. In this case, the credit loss expense is the debit, or kind of like the bad debt expense, and the allowance for credit losses is kind of like the allowance for doubtful accounts. That's the credit. So you have to take into account how much they're expecting will not be collected. So with all that, let's go down here to the journal entry just to kind of put it into, debits and credits. So they debit the full accounts receivable that they just received, $500,000. They debit the credit loss expense. So again, that's the debit to this credit down here, $10,000, because that's the 2% that they're expecting will not be collectible. And then you credit the cash. That was the total amount that they paid, $450,000. And then you have the credit for the gain on the factoring because, again, they paid $50,000 less than the accounts receivable was actually worth. So that's a gain on their end. And then finally, you credit the allowance for credit loss because, again, they are expecting these $10,000 to be uncollectible. And since it's without recourse, they are responsible for any of these losses, any of these amounts that are uncollectible. So that's without recourse, and that's from the side of the factor. This is an important journal entry that you need to know. So kind of make sure you understand what we were going over here. Maybe pause the video if you need to. And now let's go to the next question. All right, here we are at question 5. Which of the following best describes this transaction? Okay, so let's walk through this and see what this sounds like to us, because it looks like it's asking us if this is pledging, assignment, factoring with or without recourse. So let's walk through this. Brighton Corp sold $400,000 of its accounts receivable to a finance company. Okay, so they sold it. So just pointing this out right away, based off everything we've learned so far, that should be a clue to you that it's not pledging or assignment, because pledging or assignment would be they're not selling it, they are just pledging it or saying that or assigning it as collateral for a loan. So already we know it's not one of those two. So it's going to be with or without recourse. So let's keep reading. As part of the agreement, Brighton Corp received $370,000 in cash and agreed to reimburse the finance company for any accounts that are not collected within 90 days. Okay, that should tell you the answer right there, but let's keep reading. Brighton Corp will record a liability for potential uncollectible accounts equal to 5% of the receivables. Remember, Brighton Corp is the one selling. So if you need to, pause the video, think about this. But again, I think that you should be able to already know the answer. So let's go ahead and look at the answer to talk a little bit more about this. All right, yeah, the answer is C, factoring with recourse. So again, you probably should have gotten that. So let's walk through this just to make sure that's clear. This transaction is classified as factoring with recourse because Brighton Corp, again, they're the ones selling, sold its receivables to the finance company, but retained responsibility for any receivables that are not collected within the specified period. The presence of a recourse clause means Brighton Corp must reimburse the finance company for any uncollectible accounts, making it a factoring with recourse arrangement. Because again, they're saying Brighton Corp, again, they're the one selling. They received $370,000 in cash, so that's good, but they agreed to reimburse the finance company for any accounts that are not collected within 90 days. If this was without recourse, the financing company would be the one responsible for those uncollectible accounts. But since this is with recourse, the finance company can come back to them within this 90-day time frame and say, hey, these weren't collected, so you need to reimburse us or something, give us the money back in some way. So that is the idea behind with recourse factoring. Now let's talk a little bit about the other ones. Again, pledging involves using receivables as collateral for a loan. Same with assignment. Assignment's a little bit more formal, a little bit more specific, but they're very similar. They're both just having something as collateral, the accounts receivable as collateral for a loan until it's defaulted. And then factoring without recourse, again, that would mean that the factor assumes all the risk of non-payment. They are assuming the risk. The ones who are buying the accounts receivable, they're assuming the risk. So the seller has no further obligation after they sell the receivables when you're doing without recourse. So we talked about a lot in just 5 questions. Before we go any further, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the material, you will notice as you're doing the questions, the things that keep popping up. You've seen 3 or 4 questions trying to teach you how to calculate the journal entry for factoring without recourse from the buyer's perspective, or maybe from the seller's perspective, or whatever the case is. You just keep seeing these things pop up in the questions, and you know they are important because the review course is trying to teach you these things throughout multiple questions. So you take some time during and after you're studying to think about it, summarize it into pillar topics. These are the most important things you learned from the questions. And as you do this each day, you will have all your pillar topics, all the most important things that you learned from your studying so that you know that for test day. So let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. Let's start off with secured borrowing, pledging, and assignment. Again, as far as the exam goes, seems like these are pretty similar. All 3 involve using receivables as collateral for a loan instead of selling them outright, with the company retaining control and collection responsibility. The main difference is the level of legal formality and specificity of the collateral. Again, pledging, a little bit less formal, but it's very similar to assignment. Assignment really is just being a little bit more formal, like you're signing a document saying that these specific receivables will be able to be taken if it's defaulted or things like that. But the general idea is with all of these, with secured borrowing, which is kind of just the general term, pledging and assignment, all 3 of them really just refer to a company having their accounts receivable as collateral for a loan. So that's the main idea there. Now let's talk about factoring without recourse from the factor or the buyer's perspective. The factor purchases receivables and assumes all risk of non-payment, recording the full value as an asset. The factor or buyer, again, recognizes any expected credit losses. So they are the ones who are going to take on the responsibility of anything that's uncollectible or any loss that comes from this. And then as far as from the seller's perspective, still with factoring without recourse, the seller sells its receivables and transfers all risk, removing them from its balance sheet. The seller records a loss if the cash received is less than the book value of the receivables. But overall, they are just selling them, getting rid of them, and they no longer have those receivables on their balance sheet. Now, with factoring with recourse, the seller retains responsibility. I mean, they do sell the receivables, so they're no longer on their balance sheet, but they do have responsibility for the uncollectible accounts and must reimburse the factor if customers don't pay. That could be that the factor sells the receivables back to the seller, or it could be that the seller just has to pay the factor or something like that. The seller records a recourse liability and a larger loss on sale due to this obligation. So overall, the main things that you needed to learn from this is a little bit about secured borrowing, pledging, and assignment, but mainly factoring is the big idea with this topic on the blueprint. And we learned a lot. And with that, that is the end of the video. Before you go, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Again, it is only 1 hour. It is free, and we will show you how to pass the CPA exam without wasting months or even years of your time by being efficient and effective with your studying. We'll teach you things like studying in the morning, doing constant review every day to make sure you don't forget the material, and of course, going to the questions because that is the most important thing that you need to know how to do. So make sure you check out that webinar. Also, just a reminder, we only went over 5 questions in today's video, but if you like this and you like our other material, just remember that Superfast CPA Pro members will have access to the full 10-question video when we post it in the members forum. So if you like this, again, you can become a Pro member and get more access to these videos and to a lot of our other products as well. So make sure you check out the webinar and make sure you become a Pro member. With all that, if you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.